markets are convinced that there's going to be a cut in January. Are they right?
First, we have been successful so far in disinflation, and victory against inflation is on track in the euro area. Remember, we were at more than 10% 2 years ago. We are now at 2.4 in December, and we expect an average of 2.1 this year, so very close to our target. For next week, we will see, but there is a plausible consensus that we will go on acting at each meeting, which we have successfully practiced since September. And we said from the start a meeting-by-meeting approach, which is not a quarter-by-quarter approach, let me stress it. So, and if we are decisive enough about the pace of the cuts, we probably don't need now to increase the magnitude of the cuts, which could be another debate. I wouldn't exclude this possibility for the future, but this is what I call agile pragmatism. We should be ready to act. If we go on this pace, we could be by 10% by summer, but around 2%, which is a neutral rate.
Okay, so before you get to the 2%, I mean, what would need to happen for you to pause? So first of all, pause next week. If it's not, I mean, it's almost a done deal, but what would need to happen from now until, the next meeting? And in general, what would need to happen, maybe from the Trump policies, for you to pause?
No, first, we will look at inflation. Including core inflation. If I look at our side of the Atlantic, I'm not very worried. I am vigilant but not worried about inflation, including the effect of Mr. Trump's policies.
Which are not modeled. Are they modeled yet?
No, we don't know yet exactly, but there are obviously less tensions on the labor market and on the goods market in Europe. And we will see the degree of possible retaliation, but I would say that the perspective about inflation is quite assured. On core inflation, we are still at 2.7%. We expect it to fall back to 2.3 this year. And if you look at goods, manufactured goods, inflation is very low in the euro area. It's a bit more sticky on services, but it's logical, and we expect it to fall. This is already what we see in France, for example, where core inflation is around 2% already.
Could you go faster, actually, to get to that 2% neutral rate?
Depending on the news and on the flow of incoming data. I am a pragmatist, and this is what I call agile pragmatism, being ready to adjust, and we are not on a preset curve. But let us suppose we are around the 2%, so the neutral rate by summer. Then we would have to assess if we stay there or if we go further. But I would say that till then, we will look at data, but probably our curve is the simplest among major central banks. If I may stress it, we were the earliest to cut rates last June. We are the lowest at 3%. We are much below the Fed or the Bank of England, which are above 4%. And we have probably the simplest task for the months to come, but it remains data dependent, pragmatism.
But so, Governor, for the moment, you can't rule out going below the neutral rate. That's fair, right? You could go below 2%, below the neutral rate?
This is not a question for now. We are at 3%, and as I said, probably there is a plausible consensus to act at each meeting.
And the data so far supports your view 100%, that actually you will do gradual.
Yes, on inflation, we are on course. The news are even a bit better than what we expected. So we'll see. Long-term rates are a different story. Because for short-term rates and monetary policy, decoupling is not an issue. We are independent on each side of the Atlantic. For long-term rates, there are spillover effects. There is some kind of co-movements. Although the levels are very different. Yeah. If you look at the 10 years for German bonds, they are 2.5. And if you look at US 10 years, they are above 4.5%. But here, there is a rise, a core rise, so to say, a partial core rise due to inflation fears about fiscal policy and global uncertainty. Right. And this is what you see in term premia. There is a lesson here. We shouldn't let the benefits of monetary easing and disinflation be wasted by too lax fiscal policy or economic fragmentation. Or to put it in other words, an economic policy, in order to be efficient, must be consistent.
How do you see the moves in euro?
We see the move on growth probably slightly positive. We expect around 1% this year. And we will have an increase of real income due to the success of disinflation. So it could be a gradual recovery till next year. But this is not enough. So we need to push on structural reform. This is the Draghi and Letta agenda. And if Mr. Trump's program has a virtue for Europe, it should act as a wake-up call. Clearly, it's time to accelerate on structural reforms for growth and innovation.
Do you worry about growth in Germany and growth in the Eurozone because of Trump policies that the first time around were really against Germany?
I don't think there are huge differences among European countries. Obviously, the southern economies are now more dynamic, but remember some years ago it was exactly the opposite. No, we have a common challenge. And we must take probably the best lessons of the US economy, let us be honest. This is what I could call the three I's. We should integrate more the single market. We should invest more and better, thanks to private savings. This is a famous savings and investment union, but it's time to implement it and not only to speak about it. And the third I is to innovate more and quicker, and this is about diminishing bureaucracy. Yeah. None of these three I's has fiscal cost, by the way. So let us be decisive and take this opportunity really to wake up.
Governor, when you look at the climate change policies in the US, and we're expecting them really to be retrenched, what does it mean for your work at the central bank for mitigation?
Obviously, we regret Mr. Trump's announcement to leave the Paris Agreement. This was not a surprise, and this is what he did during his first term. But remember the positive reaction we had in 2017. We created in Paris the so-called NGFS, Network for Greening the Financial System. It's based in Paris. It's a coalition of the willing, a very enthusiastic one. We were 8 members at the start. We are now about 140 members. And this coalition of the willing, believe me, is more committed and active than ever. We published just last year a long-term climate scenario. We will publish this year the first ever short-term scenarios. And we have been tasked by the G20 presidency to work on so-called transition plans, how to reduce for financial institutions and for corporates the CO2 emissions.
Governor,
so it's a coalition approach, but it can be very efficient.
You've been very clear that actually the ECB probably has the most comfortable or easiest job right now.
I said simplest.
Simplest job, but of course we've seen a lot of market moves. In certain cases we worry about market dislocation because of the Fed and what they need to do on market adjustments. Is that a problem for the ECB?
No, as I said, monetary policies are independent on both sides of the Atlantic, and we started earlier and it was not an issue. So each monetary policy is targeted to domestic inflation, and this is the way it should proceed. Long-term interest rates are a different story.
But you could see big bond moves, right? As, I guess, bond vigilantes go around a bit like what they did in the UK 2 weeks ago.
I think the euro area is so large that it is much more stable. And this is a huge advantage of the euro, by the way. And in the euro area, fiscal policy is probably less lax, inflation is lower, short-term interest rates are lower, so there are good reasons to have this differential in long-term interest rates, about 2%, which I mentioned earlier. But again, we must run consistent economic policies, especially between monetary, fiscal, and trade policies.